Today I'm going to show you why the Dow is the worst stock index. I've never understood why the Dow is still being used today. Nearly every major finance website or finance show will list the Dow Jones Industrial Average number of points up or down as an indicator. Here you can see right here from Market Watch. Dow ends higher. Why even mention Dow? Number of points up or down as an indicator of how the stock market is doing. To make matters worse, the Dow is often the first listed index shown. As you can see right here, the Dow is the first one listed. And for the longest time, you actually had to search for the S&P 500. It was sort of buried off the page. And for the longest time, the increase or decrease was listed in points only, not percentages for the Dow. When the stock market indexing wave took over from actively managed mutual funds to passively run index funds, guess which index is the most used? It isn't the Dow, but is most likely an S&P 500 index fund. There are numerous S&P 500 ETFs available. Here's a list that I just found online. There's four big ones right here. You've got Vanguard, BlackRock, and State Street. You've got over $1 trillion here of assets under management, and there's some specialty ones below. Guess how many Dow ETFs are available for the Dow Jones Industrial Average? There's only one. There's only one Dow Jones Industrial Average ETF. That shows how popular it is. It's not very popular with investors. This is the only one that's available. It's the SPDR Dow Jones Industrial Average ETF Trust, ticker symbol DIA. It has a very high 0.16% expense ratio. This compares to about 0.02, 0.03 for the S&P 500 ETFs. And the S&P 500 ETFs have about 500 stocks versus only 30. So you're really getting ripped off on something like this. What is unusual about the Dow is that there's actually people that are searching for it. If we look at Google search trends, Dow is searched for more often than the S&P 500. If we look here in blue, this is the Dow, the keyword Dow on Google's website. And we go back 5 years and we see right here during the COVID, when the stocks crashed, it went way up above everything else. And it's consistently something that's searched for quite a bit more, but it is shrinking. If we look back from 2019 on, you can see the gap is shrinking. I'm just thinking maybe it's because it's easier to type or search for Dow than the S&P 500. But then I thought a lot of people are invested in the S&P 500, so they probably have the Vanguard S&P 500 ETF, VOO, or the iShares S&P 500 ETF, which is IVV, or maybe even SPY. And you can also use Siri or Google Assistant to search for the S&P 500 price on a daily basis. So I don't really see an excuse why somebody would need to search for the Dow. Who are all these people searching for Dow? Have you ever searched for Dow before? I don't think I have. I did. This was probably the first time I've searched Dow for this video. There is some surprising data here. Now, perhaps YouTube viewers are younger than people that search on Google, but if we switch to, and this is for the US, if we switch to YouTube search, look what happens. And we're going back 5 years. SPY, which is an S&P 500 ETF, SPY is way up there. It's higher, search for with greater volume than Dow. If we look at Dow, it only was during the COVID stock market crash, a little spike, but everything else, it's way down here in blue. And when we look at the S&P 500 number, S&P 500 is the most searched for now. And SPY, you don't see Dow being the most searched for anymore. So there is hope, and perhaps it's younger people on YouTube that have given up on the Dow and are searching for the S&P 500 or something that they're invested in, which is the S&P 500. Now, if we remove the Dow and put in NASDAQ, it's going to be, now when we look at the purple, even the NASDAQ is one of the more popular search for terms, more so than the Dow. To be fair to the Dow Jones Industrial Average, it has been pretty close to the real stock market performance of the S&P 500. Sometimes it's better, sometimes it's worse. Now, I went back to 2000 to 2024. If we look here in blue, this is the Dow Jones Industrial Average. So it was actually outperforming for a little while, and now they're basically about even. But of course, I can modify this to where I can make the Dow Jones look bad. If I go back here and I change this to 2002, if I do the start date as 2002, I can make the Dow look much worse. Now, if we look at it, the S&P 500 fund has been doing better the whole time. And now look at the difference in performance, 375% versus 513% for the S&P 500. In 2002, the tech stocks kind of crashed, and I believe the S&P 500 has more tech stocks. So you're basically buying those at a low, and you see the results here, and the end performance is that the S&P 500 did better. So the index performance it's not horribly inaccurate, but there's major flaws in the index. Okay, what is this major flaw that I'm talking about? The Dow Jones Industrial Average was created by Charles Dow in 1896, and it started as 12 stocks, and they basically divided it by the average. The great thing about it, this was a great product at the time. There weren't a whole lot of stock splits and reverse stock splits. I think that was pretty well unheard of. So this index made a lot of sense. However, the flaw with the Dow Jones Industrial Average is it's price weighted. Now, what does that mean, price weighted? Most indexes are market weighted. That means the total value of the company or market capitalization, that is what determines the value of the company. It's not the share price. The share price, you can have share prices in the thousands of dollars, and the company can be worth less than a company that has the share price in the $20. It just depends on how many shares and the price per share. The problem with the Dow Jones Industrial Average is that the weighting is all messed up. So if we look at, there's 30 stocks now in the Dow Jones Industrial Average. United Healthcare, which is not the most valuable company, I think it's worth $500 billion. It's listed as number one at 9.45%. And Goldman Sachs, which is not the most valuable company, is listed at 7.55%. Both of these companies are listed as being worth more than Microsoft. Microsoft is a $1 trillion company, multiple trillions, I believe. Microsoft's worth $3.173 billion, so it's a $3 trillion company. Yet, when we look at United Healthcare, their number one holdings, United Healthcare is worth $543 billion, so a much smaller company. The thing you may notice here, looking at this now, at their number one holdings, the thing you may notice is that the stock prices start from the highest and they go to the lowest. United Healthcare has a $588 per share stock price, and if we look at the smallest one, it's got a $19 per share stock price. Intel has a $19 per share stock price, and so it has the least amount of value. So they're basically taking the share price of the company, not the market cap, and they're saying, okay, this one has a higher stock price, and so we're going to make it worth more. So a way that you could throw a monkey wrench into the Dow Jones Industrial Average is if we picked Berkshire Hathaway Class A shares, the shares of Berkshire Hathaway that have never split, it's worth $675,000 per share. If we added Berkshire Hathaway Class A shares at $675,000 per share, it would basically move all these down to like less than 1%. So you'd basically it would probably be worth like 99% of the Dow. That's why you're never going to see the Berkshire Hathaway Class A shares listed on the Dow, because their index can't handle it. The way it's designed, it just can't handle that kind of price in the stock. So that's the main flaw that I see. Now, this system 100 years ago was probably perfectly fine. In 1900 or 1896, when it was invented, basically stocks would get listed, let's say, I don't know what they listed at, $1 or $10 a share, and they would grow, and you wouldn't have so many stock splits or reverse stock splits like you have today. Numerous companies, especially penny stock, will boost the stock price, will do reverse stock splits so they can stay listed on the exchange, because being listed on the NASDAQ or New York Stock Exchange generally requires that it meet a minimum share price. And when the share price is in pennies, they have to do something. Faraday Future, which is an electric company, is now doing a reverse stock split, a 1-to-40. So they're basically getting rid of 40 shares, and each shareholder will get 1 share instead of the 40 that they have. And then it's going to be worth a higher price. But the whole company is still worth the same. It's just you're getting less shares at a higher price. It's basically just a game to boost the stock price. It does nothing to increase the value of the company. But this would create chaos with the Dow Jones Industrial Average. Now, the issue with the initial starting of the index is still there, but whenever there's a stock split or a dividend payment, it can throw the index out of whack. And so the Dow Jones Industrial Average started something called the Dow Divisor. It calculates the stock splits and dividend payments and tries to modify it to correct some of the shortcomings so that when an index component goes up or down, it's more accurate. Now, this is a new thing. They didn't have this in 1900. So the original part of the index is still the same, but this is the new part of the index. So this divisor number was 16.67 back in 1928 and as low as 0.147 as of September 2019. And so this changes based on the stock split and dividends that are paid. However, this does nothing to fix the issue when the stocks are added to the index and they're added incorrectly and the wrong percentages because of the price weighting. So there you have it. That's my video for today. Please feel free to give this video a thumbs up if you liked it, and also check out some of my referral deals. I'll put links below the comments. Have a good one.